Hello, everyone. Welcome to the final bar. Today, my guest is Jesse Felder from the Felder Report, going to give us a good big picture breakdown of what's happening. Certainly a rebound in a big way to the upside with growth leading the way over value. A lot of technology shares have been beaten down. FANG stocks, semiconductors, etc., bouncing right back up to the upside. Stocks like Tesla up double digits percentage-wise. Overall, is this a short-term bounce before the next leg down or something different? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity of the markets through the lens of technical analysis, focusing on the message of the markets themselves. You know, it's funny, so often I hear discussion of what the market should do given some macro tailwinds or headwinds, some information, some new information at the end. Charts and analyzing price behavior is all about what the markets actually are doing, how investors and traders are voting with their capital, how they're moving things, the fear and greed that drives those decisions. All of that is reflected on the chart. So if we can focus on the charts, identify key turning points, key breakdowns and breakouts, overall, you're going to be on the right side more than you're not. We have some great guests helping us along the way. I'm excited to talk with Jesse Felder today. We have more of the same through the remainder of this week. Some great guests tomorrow on Wednesday the 10th, Dana Lyons from the Lyons Share Report. On Thursday the 11th, Willie Delwich is an investment strategist now with All-Star Charts. Next week on Tuesday the 16th, we have Jason Geffert. We just interviewed Jason for our latest episode of Behind the Charts, which ran on Monday. If you missed that, go to our on-demand app, StockChartsTV.com, or the StockCharts TV on demand app on any of the app stores. You'll see my conversation with Jason. Also on March 22nd, coming up in a couple of weeks, we have Chart Madness, a March Madness bracketology stock picking exercise with myself, Greg Schnell, Tom Boley, Grayson Rhodes. We're going to have a lot of fun debating the strengths and weaknesses of 16 different stocks and end up with our final four in our championship picks, and we'll see how those portfolios do over time. Let's get to our market recap. Before we start there, I want to start with a poll. I have to say, for the first time, I think ever, I did stump Final Bar Nation, and I'll tell you what happened. Know your technical indicators. Which indicator does not imply price direction, but simply measures the strength of the underlying trend? 40% of you said RSI, 32% of you said ADX, 22% said relative strength, 6% said the parabolic SAR. So those last two, absolutely not right. The SAR is a stop loss system and very clearly tells you the direction of the underlying trend. That's kind of the point of it. Relative strength absolutely implies the strength because it's showing you does the line slope upwards or downwards. That tells you whether it's outperforming or underperforming. So it's very much directional. RSI is actually incorrect as well. Because if you think about overbought and oversold conditions, that is telling you about the price action. The higher the RSI, the stronger the positive trend. The lower the RSI, the stronger the downtrend, or the stronger the downside momentum. So it actually does tell you a directional move. ADX, the average directional movement, was designed by Wells Wilder. It's a derivative of his DMI indicators. If you've seen his books, which, boy, I forget what it's called, New Concepts in Technical Trading Systems or something kind of like that. He talks about the concept of directional movement. He shows you the spreadsheets where the actual manual worksheets where he created the indicator. And then ADX literally tells you the strength of the trend. But a high ADX doesn't tell you uptrend or downtrend trend. It just tells you a strong trend. So you have to use the DMI to actually tell you the direction. So there you go. I have, for the first time and now over a year and a half, I think, finally stumped Final Bar Nation on there. Read up on the ADX. It's a great measure of trend, but not direction. Let's continue with our market recap. So, overall, what was today about? If I would summarize it, this is one, the way that I'm seeing it, given the negativity and the breadth, giving the bearish divergences, the breakdown in a lot of the technology stocks, We could be done and we could have seen the short-term bottom and we go and make new highs from here. I see that as highly unlikely given the distribution that we've seen in a lot of those shares. So I still see further downside for semiconductors, for technology, for communication services names, the FANG types of names that have led and then have really stabilized in the last 4 to 6 months and now have broken down. I don't see today as being as much of a signal of the end, but more of a bear market bounce, a downtrend and a reaction rally to the carnage that we saw yesterday, right? The distribution that we saw yesterday. Part of what makes me feel a little bit validated on that is what the last hour happened today. Had we sort of closed at the highs of the day, I'd be getting a little nervous seeing the NASDAQ up significantly, which it certainly still was. But if you look at the charts of any, of Apple and others, they're not different. They're not, back to full on bull mode. They still have recently broken down. They have not made a higher high yet. They're still now in a short-term downtrend. I think that's still the case. This makes sense as a short-term bounce within a long-term downtrend. We might call it dead cat bounce. I could see this being that. Again, the remainder of the week tells you if that's the case or not. And the trend following models that I employ are still, are negative as of the last couple of weeks. So I'm going to assume that that's the case until proven otherwise. So what we'll do with the recap is focus on what happened today, focus on the long-term trends, what levels we want to pay attention to. So the S&P closed up around 1.4%, around 3875. Now it came down from 3,900 in the last hour. And again, that tends to be institutions, ETFs are all kind of in that last hour. There tends to be a lot of volume there. So if you look at the last 2 days, the opening 30 to 60 minutes and the closing 30 to 60 minutes, that shows you sort of the overall scenario here, the overall feel of this market. Distribution going into the close usually means larger investors are lightening up. The NASDAQ certainly a nice bounce today, up almost 4%, came off a bit toward the end. Mid caps and small caps both up, but large caps led the way. Large cap growth was really the story here. The VIX back down just below 24 now. Looking at other asset classes, so the bounce higher in bonds certainly had a big part of to do with today. So 10-year yields back down below 155. The TLT bouncing up a little bit. That's a very different feel than what we've had before today. And so the nice bounce in bond prices, pullback in yields, are an indication that yields might have had their run for a little while. Certainly fueling a bounce in the growth story today. Gold, it now is proven can actually go up in a decent way, up over 2% today. This is the GLD actually bouncing right off of a pretty key support level. It's actually an interesting chart to look at. Let's go there next. Here's the chart of the GLD. Actually gapped up. I didn't bump these lines over, but you look here. This is actually the April, May, June lows from last year. That's also the 61.8% retracement level, using the March low and the August high. So there's a lot of sort of a confluence of support right about where we ended up over the last week. So this bounce today makes a ton of technical sense, given that, and also the fact that the GLD was oversold. Last 2 times we've been oversold. It hasn't happened very often, but we've had nice bounces for the next 2 to 4 weeks afterwards. So this may be the beginning of gold bouncing back up to the 50-day moving average. That would be about a similar upswing to what we saw back here in the month of December of last year before it topped out in January. So that's certainly a chart to watch to see if that materializes. Finally, cryptocurrencies essentially up for the most part. Bitcoin was up about 3.6%, closing just above 54,000 again, and that's rallied pretty good in the last, over the weekend into the last couple of days. Let's look at a chart of the S&P 500 and see how things are playing out. So, essentially what I did here, I sort of drew this line taking the recent high. So if we take the high from mid-February, that connects pretty well with a couple of these tactical highs here in the month of February. We've made this short-term pattern of lower highs and lower lows. We've bounced right back up to that trend line, back above the 50-day moving average today. The question is, do we hold at that level, continue to go lower, right? We need to make, I would argue, we need to go back to a new all-time high for me to think that this bullish sort of downtrend, this bearish downtrend is over, and it was a shorter ride than I would have expected. I will acknowledge that if we break to new highs. Until we do that, I'm still thinking the path of least resistance is lower, just given the overall distribution, the divergences we've had, the distribution up until today. I don't think today is enough to signal to me that things are sort of are evaporated here. Having said that, you're seeing a lot of bounces in a lot of places, and I can't help but notice that the RSI bottomed out so far right at 40, which is very much a bull market sort of configuration, right? The pullbacks give you an RSI around 40, and we become overbought on rallies. That would be the thing to look for if we do sort of bounce higher from here. Sectors, as I mentioned earlier, this was back to offense, consumer discretionary technology. Very interesting, though, that third and fourth were utilities and real estate, which tend to be pretty defensive and are high dividend payers. Sorry, we're just jumping around here as we're processing the last closes. Communication services is in the mix as well. At the bottom, it's a lot of the sectors that have been juiced recently. Energy pulling back with oil prices coming down, the XLE down almost 2%. Financials after that with yields coming off a bit. In terms of individual stocks and themes, I mean, this is basically everything that was down pretty good in the last couple days, bouncing up higher. Renewable energy equipment. These are solar stocks, semiconductors, computer hardware. That's Apple's group. Software is Microsoft's group. These are the stocks or the groups in the top 10. Tesla's group, obviously at the top, and Tesla has been struggling. Ford, GM, the traditional automakers have actually been holding up pretty nicely. On the bottom, it's all energy, mostly energy, banks as well. So this was a very much a mean reversion. The question for me is, do those stocks like Apple regain their previous highs to the point that you feel that there's a further accumulation in store? I don't know if we've seen that yet based on what I've seen today. Let's take a quick commercial break. Back with my guest, Jesse Felder. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close for the Final Bar. As a reminder, we love to hear from you. We do another mailbag segment later in today's show. We will do another one at the end of this week, and we'd love to answer one of your questions on the air. Shoot us an email with any questions that come up as you're analyzing your own charts. You're reading about the markets, you're following the markets, you're trading the markets. How can we help you do better with all of the above? Our email is thefinalbar@stockcharts.com. On Twitter, just tag us in a comment at FinalBarSCTV. On our YouTube channel, just put a comment below the video that you're watching. We'll capture all of those and hope to answer one of your questions on Friday's show. Also, as a reminder, the new StockCharts TV on-demand app is live and out in all its goodness. Go to StockChartsTV.com and set up a free account and start watching all of our videos on demand for free immediately. Also, we're on all the app stores, so download it to your Apple devices, Android devices, Roku, et cetera, and please enjoy. I want to welcome on my guest, Jesse Felder from the Felder Report. Jesse, fellow Pacific Northwesterner, joining us to share some thoughts on the overall market. Jesse, welcome back.
Yeah, thanks, David, for having me. I'm glad to be back.
So as always, I'm humbled when I bring on someone who I consider more of a power stock charts user than myself, and I think you fit the bill, and I appreciate you putting some charts together for us. We're starting out with energy, which has obviously been an incredible story in recent weeks, giving back a little bit of it today, but talk us through your big picture perspective with energy.
Yeah, I mean, obviously this is a 20+ year chart. I think it's one of the same charts I used the last time you had me on, and to me, I was looking back last fall, and you could see the relative strength of energy versus the S&P 500 make a new low last fall, even though the oil price had rebounded dramatically. To me, that was a very strong bullish divergence for energy prices late last year. But there's still a huge gap here. I mean, typically the relative performance of energy should track with oil prices. When oil prices are strong, energy should outperform and vice versa. And so this big gap here suggests to me that there's still upside for the relative performance. I think one of the things that I said, though, last time we talked was that, that outperformance can come through either energy, performing really, really well versus the S&P, or, just holding up, during a decline. And I thought, maybe it was a little bit more likely that we'd see the latter. And I was dead wrong. Energy's just been screaming higher, even as the S&P has, continued to move higher. But I think maybe going forward, this outperformance could come more from, energy holding up relatively better than the broad stock market.
It's amazing. These energy stocks have had such a run. And if you look at a 6-month chart of something like FANG or Occidental, right, it looks like it's just going up and to the right, like this outrageous uptrend. But if you zoom out and look at a longer term history, it kind of makes sense what's going on. You can see that upside potential there. Now, second one is talking about the S&P big picture with a technical approach that tells us about exhaustion. What is this one?
Yeah, so this is a chart of the S&P 500, and on the top of the chart are StockCharts' two measures of Hindenburg Omens on the NASDAQ and the New York Stock Exchange. And it's something that I pay close attention to. I mean, the Hindenburg Omen, I think, has kind of a bad rap that it predicts a crash, and that doesn't work too well as an indicator. But when you do see clusters of omens triggered, it's, to me, just a standard breath warning. And so we've seen, I think, 8 Hindenburg Omens triggered over the last 10 trading days, which is, relatively significant. Typically, if you look over the last 3-4 years, when we've reached this kind of a level of omens triggered, it usually leads to a correction. The last time we've seen anything like it, actually any cluster of Hindenburg Omens, was last, a year ago. A little over a year ago in middle of February. And that was a pretty good indicator that the dispersion in the market was sending a bearish signal.
Now, those, I don't want to take too much time with it, Jesse, but for those that aren't familiar with the Hindenburg Omen, obviously the imagery of the Hindenburg, you kind of get a sense of what it's suggesting, but can you tell just a very basic idea what is that actually, what comprises the Hindenburg Omen? What is it looking at?
Yeah, I mean, it's basically you have to get a fair number of new highs and new lows, 52-week new highs and 52-week new lows on both exchanges to trigger a Hindenburg Omen. So we probably didn't trigger one today simply because we didn't have enough new lows on either index.
Right. The third chart is looking at interest rates, and obviously that's been, arguably one of the biggest drivers in what we've seen recently. Walk us through this last chart.
Yeah, so this is just, the 10-year treasury yield inverted. That's the red line versus the relative strength of growth stocks versus the S&P 500. You can see there's a pretty clear correlation here. But what to me is, two things. One, the relative strength of growth went far beyond what could be justified by interest rates. I mean, by the way I look at it, growth essentially got to the point where it's pricing in negative interest rates, and we didn't get there. And when interest rates reversed higher, that's led to this kind of crash in a lot of these, long duration names, as I call them. And there's still a gap there that suggests to me that even if interest rates don't continue rising, there's probably some give back that growth needs to do, just because it got so overextended over the past 12 months or so.
Jesse, this is a great take. I love the long-term perspective that you've brought with this and hitting on essentially, I think, all the key themes that equity investors should have in mind right now. Jesse Felder, such a pleasure to have you back on. Stay safe, and we'll talk to you again soon.
Thank you much.
That's Jesse Felder from the Felder Report. You can find him at thefelderreport.com. I value and I appreciate so much people that come on the show and bring long-term charts with them. And the chart that Jesse showed of energy, and if you feel like the run in energy has been severe, which again, on a short-term time frame, it certainly felt like that. But if you look at how far it has come down up until the last 6 months, you can see why the expectation of there being further upside from here is not unrealistic. It makes me think of my conversation with Jonathan Krinsky last week when we looked at Deutsche Bank. I think it was last Tuesday's show. Similar idea, right? The run in some of these banks feels extreme, but if you look at a number of years, you can see we're still really early on, or potentially very much early on. If you look at the long-term cycle and how far some of these things have been beaten down for so long, it's a great take overall. Let's continue on. Our next segment is the final bar mailbag. As a reminder, one of my favorite parts of the show is to hear from you, things you're running into, things you like, things you don't, things you're struggling with. And again, if we can take a few moments a couple times a week and point you in the right direction, I am certainly more than happy to do so. Question number one is a longer one, so I'm going to sort of tighten it up just a little bit. I hear a lot about growth and value as the IWF to IWD chart shows this may be a time to invest in value stocks, but how are those labels determined? How would I scan for value stocks? Are sectors the best way to think about growth and value? I hear that financials and energy represent value stocks, but industrials and materials, plus industrials and materials maybe. How is this determined? Really, really good question. On my final investor, I'm sorry, not final investor, the mindful investor. That was great. The mindful investor live chart list. I've got a growth versus value chart that is sort of what you talked about. This is IWF over IWD. So here's the thing. Those labels of growth and value, I would argue, are broad generalizations about types of companies. And there are different ways that different vendors, different index providers bucket things. But in general, a growth company is going to be something more, sort of a growth story, something that's trying to grow earnings over time. It's a long-term story with earnings growth potential over the long term. These are things like technology, some healthcare, consumer, discretionary names, communication services, internet names, all sort of fit into that bucket. Value spaces are more sort of what you imply, things like banks, energy stocks, big industrials, materials, et cetera. And so, these are general ways of sort of describing companies. However, here's the thing, stocks like Microsoft in general actually can be labeled both a growth and a value stock, depending on how you look at it. And in some cases, these indexes actually double count stocks. So stocks are actually in both the growth and the value index. They actually have separate indexes called the pure growth and pure value, which eliminate that and focus on just the stocks that are unique for each of those two buckets. I think the way you described it based on sectors isn't a bad way to think of it. And in general, the challenge with this is that it oversimplifies, right? I would think of growth versus value as one of the things that I would look at to try to make sense of the market relationships. It's part of a series of ratios that I look at. Growth versus value, equal weight versus large cap or cap weighted tells you about small caps versus large. Small versus large would be a different way to look at that. High beta versus low volatility tells you a little about the riskiness of stocks and what they're doing. If you do all that, you'll get a sense of what's working and what isn't. Sectors are a really good way to do that as well. Just keep in mind that not all sectors are totally homogenous. So, in consumer, you have things that are much growthier than other parts of it, depending on the business, how mature the industry is, and so forth. Best way you can do it is look at something like the IWF or the IWD or any ETF and look at what stocks are in there, what sectors are weighted in there, and that will tell you a lot about the performance of the ETF. Thank you so much for that question. Next one, good afternoon. To what level do you believe the XLE can pull back? It's interesting, we were just talking with Jesse Felder about energy stocks there and thinking about it, how far could they pull back? So certainly they bounce back or bounce lower today. So we can see that they go down, but on my 2-year chart, today's bloodbath of being down a couple percent is, it's not even below the support level that I drew here. This is actually the low from last summer that ended up being the high of this congestion area from February before the market rolled over. We're right back up at that same point. So we just get back a little bit of this, how low could things go? I mean, in general, my very simplistic version of this is looking at higher highs and higher lows. But on me, this says we go down to 48, which is the close here on that move lower. So that 47 to 48 region would be a reasonable pullback still within the context of a really good uptrend. That would also take us down to this trend line from the October lows and the January lows. That would be a decent place that I would be looking at. As long as we hold that on any pullback, I think that's the way to think of it. If you hear the way I tend to describe it, it's rarely a very specific level. It's more about if we would hold this point, then I would feel okay with it, which gives you a lot of room between here and then to jump around, because my goal is to get away from the noisiness of every individual day, the flickering ticks, focus more on the long-term evolution. Next question. For those individuals who have positions in FANG stocks, should they cut losers short or hold until they rebound? For example, Apple will eventually go up if a long-term outlook is positive. Would you recommend cut a position with a loss and try and buy on a further downtrend, or just hold and work through the shift? So, that's a really tough question to answer. And I certainly don't want to try to suggest what you want to do. That is very much individual to you and your situation. I've talked to a financial professional about, making any sort of decision like that. What I would tell you is just in terms of the chart itself, it's all about your time frame, right? So if you're a long-term investor and you are your runway is a couple years down the road, then arguably a pullback like this in a stock like Apple, even if it goes down another 5, 10, 15%, could actually be a really good opportunity to accumulate at a, at a cyclically weak point in a long-term uptrend. But if you're a short-term investor, you may have already been well past the point that you're trying to be selling or shorting or riding this move lower. I mean, in terms of the overall trajectory of a stock like Apple, it makes sense that we would bounce off of the oversold conditions, which we've seen. We have a bit of a bullish divergence with lower lows in the price and higher lows in the RSI. Could see a bit more of a bounce, maybe up to the 50-day moving average. But overall, I think for me, the trend still remains lower as long as we remain below these most recent swing highs. And that's what I think tells you. Now we've made this pattern of lower highs and lower lows. As long as that pattern continues, I would argue the trend is down until proven otherwise. We look at the long-term trend. Certainly, there's potential for downside from here. So it's hard to tell again, particularly how you would think about it. I would be focusing more on what question you are trying to answer, what game you are trying to win in terms of timeframes, and that can help you figure out where to be looking. One final question, we have to move on. If I'm curious if future price levels can be set by using measured moves of past price action, then is there a similar method for measuring time? It's a really great question. So we talk about Fibonacci retracements a lot, right? So on the chart of Apple, we would take here and we would go to Fibonacci retracements, and we would go to here and maybe go to the high and project that and use that as a way to identify price. But this has no time component. It's just price levels. If I go to where I added the Fibonacci retracements, go down a little bit, you'll see things like Fibonacci time zones, which actually does time analysis based on the Fibonacci retracement. Cycle lines, which looks at a cyclical pattern and identifies if there's a repetitive cycle to price movements. Elliott wave, Gann analysis, those are methodologies that have a specific time component, which are designed to tell you, and Gann in particular comes to mind as something that is really driven off of the relationship between price cycles and time cycles and insisting that there's a relationship there. Maybe that's something we can dig into a little more detail, but I would look at some of those tools and look for people that use those to get a sense of how they work. Thanks so much, everyone, for all those questions. Those are really, really good. I appreciate you sending them in. If you have other questions, shoot them my way, and we'll have another mailbag segment at the end of the week. For now, we need to wrap the show. 3 charts, 3 minutes. The 3 and 3. Let's get to it. Chart number 1 is Dow theory. It's funny, as you can tell from my language and the way I'm discussing the markets overall, I would argue, the chances of us going lower, in my opinion, overall are stronger than us going higher. However, you have to recognize when there's been a significant move and we, expect the reversion to the other way. Just like I thought Apple and other stocks were overextended, and the bearish divergences on things like semiconductors tell me long-term, I think there's more of a corrective behavior that needs to happen. You've also seen a lot of growth stocks become oversold very quickly and pull off very significantly over the last month. So reasonable to see a bounce like we did today, even a little bit further, and still be within the context of an overall downtrend. Charts that make me question that thesis, and as always, the good thing about evidence is it's important to look at evidence that challenges your thesis. That's how you unwind or minimize things like confirmation bias. For me, the Dow theory chart is a great example of that. When I look at the Dow theory chart, looking at the Dow Industrials on the top and the Dow Transports on the bottom, I'm seeing a chart that's in an uptrend. I'm seeing both of these recently having confirmed new all-time highs. And the Dow Industrials, the Dow Transports continuing to go to new highs is a bullish comp market. That's not a bearish market. So you're not getting all the confirmation from, it's not like everything is so obviously negative that you want to get out of the way. I don't think it's as particularly clear. Finally, the last one is here, Discovery, DISCA. When I'm looking at some of the charts, and I'm thinking of stocks that have been rated very highly. The 2 top-rated scooter rank names are Discovery, DISCA, and Viacom, VIAC. Both of those came off significantly today. Discovery down about 6%. Bearish engulfing pattern right now in Discovery, which suggests short-term weakness. So it tells me that certainly some of these stocks that have had incredible runs can have some pullbacks. The growth stocks that have been beaten down can certainly revert to the upside. The question is more the longer-term trend and what we're seeing on Discovery. It's when we pull back, do we remain above the previous swing low, which is all the way down to 50. Folks, that is our show for today. A special thank you to Jesse Felder joining us from Oregon. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.